Hey everyone! Great to have you back on the channel. Today we are jumping into one of the most exciting and potentially profitable subjects, investing. We're going to cover some of the top investment strategies for beginners that could help you move closer to your first $1 million. Sounds exciting, right? Don't worry if you're just getting started. We'll break everything down and explain, easy and simple. Investing might seem as complex as solving a giant puzzle, but it's really just a method to steadily grow your wealth. The key is to start with a good plan, stay consistent, and be patient. Let's jump in. Before we get into the specifics, let's go over the basics. Investing is all about placing your money into assets with the expectation that they'll increase in value over time. These assets can be stocks, bonds, real estate, or even your own business. The goal is to let your money do the heavy lifting for you, rather than doing the hard part by yourself. Let's talk about risk and return, two key concepts in investing. Risk is the possibility that you might lose money, while return is the potential to make more money. For example, investing in a startup can be risky because it might either take off or fail. On the flip side, investing in a big, stable company is less risky, but your potential gains might be smaller. The lesson here? Diversify. Don't put all your money in one place so you can balance the risks and rewards. Index funds. Index funds are like the all-stars of investing, aiming to track the performance of a major market index. Picture the S&P 500 as a sports team made up of 500 of the top players, and investing in an index fund is like getting a season pass to watch them all. When you invest in an index fund, you're buying a slice of each company in that index. It's like grabbing a variety pack of snacks, so you don't miss out on any of the good flavors. Instead of trying to pick the winners yourself, you're backing a team that already has the best in the game. Traditional savings account. A traditional savings account is like a reliable candle, steady but not super bright. It's a basic bank account where you can park your money and earn a little interest over time. This type of account is perfect for keeping savings you might need in the near future, but don't expect anything spectacular. No fireworks or superpowers here. High interest accounts. Let's kick things off with a simple and secure option: high interest savings accounts. These accounts work like regular savings accounts, but with an added perk. Imagine a regular account as a steady, dependable bike that gets you where you need to go. A high-interest account is more like an electric bike that gives you an extra boost with every pedal. Your money earns more interest, so it grows faster. For example, a regular account might earn 1% interest, giving you $10 in a year. But with a high-interest account at 3%, you'd make $30. It's like earning extra cash without lifting a finger. Real estate crowdfunding. The real estate crowdfunding is like chipping in with a group of friends to buy a giant pizza. Instead of purchasing an entire property on your own, you team up with other investors to fund a real estate project. Picture this. You want to invest in a new apartment building, but you don't have enough to buy the whole thing. Through crowdfunding, you contribute a smaller amount along with other investors to make it happen. In return, you get a slice of the profits from renting or selling the property. It's like owning a piece of the pie without having to pay for the whole thing yourself. A Roth IRA. A Roth IRA is like a secret vault that allows your investments to grow tax-free. You contribute money that's already been taxed, and when you withdraw it in retirement, you don't owe any taxes on the gains. Think of it as planting a special tree in your backyard, where the fruit gets bigger and juicier every year. When it's time to harvest in retirement, you get to enjoy the fruit without having to share it with anyone. The sooner you start investing in a Roth IRA, the more time your money has to grow and the more you'll benefit. It's like watching your vault fill up with treasure over time. Dividend stocks. Dividend stocks are like getting a bonus from your favorite company just for being a shareholder. Think of dividends as regular paychecks the company sends your way because you own their shares. For instance, if you own stock in a company that pays dividends, you'll receive payments every quarter or year. You can use that money to cover your expenses or reinvest it to buy more shares. Companies that pay dividends tend to be stable and financially solid, making them a smart option for beginners. It's like earning steady income while growing your investment at the same time. Robo-advisors. If managing investments feels complex, using a robo-advisor could be a helpful solution. Robo-advisors are automated platforms that assist with investment management by creating and maintaining portfolios tailored to individual preferences. They take into account factors such as your risk tolerance and financial goals. Particularly useful for those new to investing, robo-advisors simplify the process by handling the selection of assets and the ongoing adjustments. You simply set your preferences, and the platform will automatically manage your investments, such as balancing between stocks and bonds for a moderate risk level. This approach offers a hands-off, stress-free way to manage your investments effectively. Invest yourself. One of the smartest investments you can make is in yourself. Whether it's furthering your education, picking up new skills, or even starting a business, investing in yourself can lead to higher earnings and greater financial freedom. Think about taking online courses, attending workshops, or diving into books on subjects you're passionate about. For example, you could learn coding to land a higher-paying job or study entrepreneurship to kickstart your own venture. The skills and knowledge you gain will unlock new opportunities and bring you closer to your financial goals. It's like giving yourself the tools to create a stronger future. Common mistakes. Investing is a powerful way to build wealth, but common mistakes can hinder your progress. To stay on track, consider these tips. 1. Stay the course. Stick to your investment plan, even when the market dips. Remember, investing is a marathon, not a sprint. For example, if the market drops, avoid panic selling, just like you would push through a tough workout to achieve long-term fitness. 2. Avoid timing the market. Trying to predict the market's movements is nearly impossible, like forecasting the weather weeks in advance. Instead of guessing, focus on long-term investments that align with your goals. 3. Diversify your portfolio. Reduce your risks by spreading investments across various asset classes. Don't put all your eggs in one basket. Along with stocks, consider adding bonds, real estate, or even commodities to your portfolio. 4. Don't ignore investment costs. Investors often overlook fees that can erode returns. Even small fund fees or trading costs can compound and reduce gains. Monitoring costs is key to maximizing long-term performance. Conclusion: investing doesn't have to be overwhelming or difficult. The key is to stay consistent and keep expanding your knowledge. Start with simple options like high-interest accounts and index funds, and as your confidence grows, explore additional investment opportunities. With the right approach and a bit of patience, you can steadily build your wealth over time. The more you learn about investing, the more empowered you'll be to make smart choices and achieve your financial goals. Thank you for tuning in. If this video was helpful, please give it a thumbs up and subscribe to the channel so you don't miss out on future content about personal finance and investing. Until next time.